I'm Doris. I'm here to share with you about my stock account. Today I'm going to be updating about the market. The US Treasury is about to starting a new tsunami. Wall Street warns that the market is not ready yet. Just after the debt ceiling deal, the Treasury is about to launch a new debt tsunami to quickly fill its coffers. That would again drain decreasing liquidity as the bank deposits more rated to cover the fee. Wall Street warns that the market was not ready. The negative impact easily dwarfs the consequences of the previous standoff over the debt ceiling issue. The Fed's quantitative tightening program has eroded bank reserves, and fund managers have been hoarding cash to encounter the recession. J.P. Morgan strategist Nicholas Penigurzoglou estimates that heavy purchases of the Treasury bonds will intensify the QT's impact on the stock and bonds, reducing their overall performance by nearly 55% this year. Citigroup macro strategist offered a similar calculation, arguing that in such a large scale, the S&P 500 could fall 5.4% in months after such a liquidity contraction, and that the high-yield credit spreads could fluctuate by 37 percent points. The sell-off scheduled on Monday will affect all asset classes as they say the money supply is already shrinking. J.P. Morgan broad liquidity measures will fall $1.1 trillion from about $25 trillion in early 2023. He said, "This is very large liquidity loss. We rarely see things like this. It is only a collapse as severe as Lehman crisis as you see in this contraction." J.P. Morgan estimates that this trend, combined with the Fed's tightening, will send liquidity indicators down at 6% annual rate, in stark contrast to the annualized growth rate of much of the past decade. In Washington in recent months, the U.S. has relied on extraordinary measures to raise money. After narrowing avoiding a default, the Treasury will start borrowing heavily. Some Wall Street estimate that the Treasury could borrow more than $1 trillion by the end of the third quarter. Several Treasury auctions on Monday will total more than $170 billion. What happens as the billions of dollars wins through the financial system is not easily predictable. Short-term Treasury bills have a variety of buyers: banks, money funds, and a large number of buyers, roughly classified as non-banks. The investment includes households, pension funds, and corporate bonds. Banks currently have limited interest in Treasury bills because the proceeds provided are unlikely to compete with the gains available to their own reserves. But even if the banks do not participate in the Treasury auction, customers switching deposits to Treasury bonds could reap havoc. Citi simulates the historical event that bank reserves fell about $500 billion in 12 weeks to estimate conditions in the coming months. Dick Wheeler, head of global macro strategy at Global Markets, said, "Any decline in the bank reserves is a typical headwind." The most optimistic scenario is supply being swept by the money market mutual funds. It was thought that buying assets from their cash pools would keep the bank reserves unchanged. They have traditionally been the buyers of the Treasury, but recently backed down in favor of the higher yields offered by the Fed's Reserve's repurchase of agreement facility. That leaves someone else, non-banks. They appear as weekly Treasury auctions, but banks are not without collateral costs. These buyers are expected to increase capital flow by clearing bank deposits to free up money to buy property. This year, capital flow has led to the elimination of regional banks and destabilizing the financial system. Spinozzi, fixed income strategist at Saxo Bank, she said, "Over the past few weeks, we have seen recording directly binders during the Treasury auction. They'll most likely absorb most of the upcoming bonds too. For now, the news came on as a relief to avoid a default and a divert attention from the aftershocks of liquidity." Meanwhile, investors' excitement about the outlook for AI puts the S&P 500 on the average of a bull market after 3 consecutive weeks of gains. At the same time, liquidity in individual stocks has been improving, contrary to overall trend. But that doesn't mean income fears about what usually happens when bank reserves fall sharply. Stock falls, credit spreads widen, and riskier assets bear the brunt. Citigroup Waller said, "This is not a good time to hold the S&P 500. Barclays said that despite AI gains, allocation to U.S. stocks was generally neutral, with mutual funds and retail investors motionless. We believe that U.S. stocks will fall sharply, and volatility will not surge as liquidity dries up," said Eric Bobar, head of asset strategy. "We face poor internal market factors, negative leading indicators, and falling liquidity, which are bad for the stock market." That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.